Hello and welcome to BYJU'S Exam Prep IAS. Welcome to another session of economy this week, wherein we are taking all the important economy related articles which have appeared in various business related newspapers from 21st January to 27th January 2023 and analyzing these articles. Now let's begin with the most important current affairs article which has grabbed the headlines in almost all the newspapers as well as the news channels has been the discussion related to the company Adani, that is the Adani Group of companies. Now, what are the points that you need to understand here? You don't have to learn the technicalities in these topics, understand the concepts, and whatever is relevant for UPSC, remember those concepts more than sufficient. Now, there is a group of companies in India, Adani Group of companies, and in recent times, it has been there in the newspapers multiple times. Now, I will not be focusing on the political discussion related to the topic here. Let's focus on the economic concepts. Now, what are the important points here? There is an American research company, that is the name of the company is Hindenburg. This company has alleged that, or it has published a report stating that there are certain events that have taken place or certain practices which are followed by Adani Group of companies which are not suitable or which are not allowed by the companies to be operating in India. Now, what do you mean by this? Follow this discussion very carefully. First, there is something called as short selling. Now, what is the meaning of a short selling? Simple. The other name for short selling is also shorting. Now, during a short selling or shorting, what generally happens is, as against the convention in the stock market. What is the convention in the stock market? You purchase a share and you sell the share, thereby generating profit. Now, many of you will be asking me, sir, when I purchase and sell a share, how do I generate profit? Simple. You buy a share at a lower price, buy low, and you will sell the share at a higher price. Let's say you will purchase a share at 100 rupee and you will sell the share at 120 rupees, thereby generating a profit or booking a profit of 20 rupees in the transaction. Against this practice of purchasing at a lower price, selling at a higher price, there is a concept called as a shorting or short selling. Now, what happens in a shorting? Imagine you own certain shares. Today, I will borrow the shares. And let's say hypothetically, the market price of the share today is 100 rupee. So, I'll borrow those shares from you. I will sell those shares. Follow this carefully. I will borrow the shares from you. I will sell those shares in the market. And let's say hypothetically, I have borrowed 10 shares from you. So, I have sold them at a market price of 100, thereby earning 1000 rupees. I'll not give you 1000 rupees, don't worry. Because I've borrowed 10 shares from you, I will give you the 10 shares back. But how? I've sold the 10 shares already. I'm able to do this for a very simple reason. I expect or I speculate that the price of this share is overvalued. Overvalued means the actual price is not 100 rupee. The price is supposed to be less than 100 rupee. So, let's say I have borrowed the shares from you today and I have told you I will give it after, let's say, 10 days or 7 days, whatever the time period is, don't worry. After 7 days or 10 days, as per the agreement, when I'm supposed to give you the shares back, what if the market price of the share is not 100, rather it is, let's say, 80 rupees per share. So, after 10 days or 7 days, I will purchase 10 shares by paying 800 rupees and I'll simply hand over these 10 shares to you. But in the process, what has happened? Today, I have taken the 10 shares from you and I've sold it in the market to earn 1000 rupees. I will use the same 1000 rupees. Let's say I'll use the same 1000 rupees after 7 days. Out of that, I've given 800 rupees to purchase the 10 shares. I will hand over the 10 shares to you, thereby making a profit of 200 rupees by conducting such transaction. This process is called as a shorting or short selling. This is against the conventional concept where long-term investments are made. You purchase at a lower price, you sell it at a higher price. But in the short selling, you purchase when the price of the share is higher, overvalued, and you borrow when the price of the share is higher and sell them in the market, and you purchase when the prices have dropped, when the prices have gone down, and hand over the shares back to the original holders of the share. This process is called as a shorting or short selling. And please understand this. In the context of India, is it allowed? Is it allowed? Short selling, is it allowed? Of course, yes. In case of India, SEBI has allowed the short selling, and this is a conventional approach where a lot of investors in the market, or let's say the traders in the market, earn huge amount of a profit. Now, what is the connection of shorting or short selling with Adani Group of companies? The research company which I mentioned earlier, Hindenburg Research Company, very well-known company, is basically a company which is involved, which generates a lot of profits in shorting or short selling of these shares. And it's not just that they are involved in a shorting or short selling, they publish all of these reports just to inform the public about what kind of activities are conducted by such companies. Now, Adani Group of companies is not a very small company. It's a very, very large company, one of the very big companies in India. And what is the reason why they have basically raised a red flag about this company's practices? Follow this very carefully. In the Adani Group of companies, around 5 to 6 companies, right? Let's say around 5 companies, these are listed companies. And in these listed companies, the promoters, which is Mr. Adani and relatives, holds more than 70%, almost around 70 to 75% of the ownership. And remaining amount or remaining number of shares are present in the market, which are purchased by retail investors, which are purchased by institutional investors, foreign institutional investors, etc. Now, the problem that has been cited by this research company is simply this. The promoter holds, let's say hypothetically, around 75% of the shares in a company, which means remaining 25% of the shares are available for trading in the market. And please remember the technical term here. This 25% which is available for trading in the market is called as a float or free float. And why this is important? Important for a very simple reason. Promoters generally don't tend to sell the shares of their own company. They do not dump the shares of the company that they generally own, which means remaining 25% of the shares of the company are available for trading purposes. Now, the concern that has been raised by this research company is that even out of this 25% of the shares or the free float which is available in the market for trading purposes, a large amount of it, a large percentage of it is owned by some other companies which are either directly or indirectly related to the owner of this company, that is Mr. Gautam Adani. Again, I'll not get into the technicalities of it. Let's say hypothetically, around 10 to 12%, whatever the exact number, you don't worry. Around 10 to 12%, and let me take a lower threshold here. 10% of this 25% of the free float is owned by either directly or indirectly controlled companies of Mr. Gautam Adani. And again, this is a research report. I'm not making up a story here. You don't worry about the facts, understand the concept here. Which means, even if you deduct 10% out of 25%, how many shares are actually free floating? 15% of the shares are free floating. And the concept that you need to understand and remember here is how these companies are able to invest and purchase the shares in India. That is basically a concept called as a round tripping. The companies are able to use the concept of round tripping, bring in the investment back into India, purchase the shares of these group of companies. And the issue here is that once 10% is deducted here, only 15% of the shares are available in the market. And have a look at this. Promoter doesn't sell the shares of the company. Only small part of the shares are in a free float, and that too foreign companies or foreign investors are bringing money into India and purchasing the shares of this company the demand for the shares goes up. As a result of this, the market price of the shares also goes up. And that is, again, this is as per the report, that is one of the reasons why the wealth of Mr. Gautam Adani has expanded exponentially by 200%, 250%, 300% in the last couple of years. Right? So again, from the context of UPSC, what are the important points here? One, you will have to remember the concept of short selling. Second, you will have to understand the concept of round tripping. And the third very important point that you need to understand here is the idea of the FPO, for follow-on public offering. FPO stands for follow-on public offering. Now, what is this idea of a follow-on public offering? The Adani Group of companies is actually going for an FPO right now. And after the report was made public, after the report was published, very small portion of FPO was subscribed by the investors. And not only that, the market prices of shares of many of these listed companies actually fell down. That is within the Adani Group of companies. Now, what is this idea of an FPO? FPO stands for follow-on public offering. The follow-on public offering is done by the companies which already have done IPO, initial public offering. Now, let me take a current affairs example so that you understand what I'm talking about. I'm pretty sure all of you heard of Paytm company, Zomato company, etc. These two companies, very well known in India, have conducted IPO very, very recently. What is an IPO? Initial public offering simply means now the shares of the company are available for the public for trading purposes. In simple terms, until this is done, the ownership or the shares of the company are there within limited number of investors. Now these shares are there in the public domain for trading purposes, which means you can purchase the shares of this company, you can sell the shares of the same company. So whenever an IPO is done, it simply means the shares are available for the public for trading purposes. Now a company which has already gone for an IPO, whenever it will again issue the shares in the market, that is called as an FPO. So the Adani Group of companies is basically conducting an FPO right now. And that is the concept that you need to remember. Now these are the three very important points. Let's go beyond this. Sir, why should I read this for UPSC? Understood. Short selling is required? Done. FPO is required? Checked. And the third one that I have discussed is round tripping, checked. But apart from this, is there any other important point I need to understand for UPSC examination? Of course, yes. That is, if such a company, if all the points which have been pointed out or which have been observed in the report by the Hindenburg research turn out to be correct. In fact, I'll be very clear here. The Adani Group of companies has actually given a clarification, has given a rebuttal to this company's allegations, and it's a very small report of more than 400 pages, which was published very recently, that is on Sunday, that is yesterday. But going beyond this, imagine if all of these points which have been mentioned by the report are correct, which means there is a lot of shady activities which are being conducted by this company. And if this turns out to be true, and again I'll repeat it, if this turns out to be true, then there's going to be a huge impact on the stock market. Many of you will simply say, sir, this company will suffer, agreed, but why should the stock market suffer? For a very simple reason, this is not a very small group of companies. The market capitalization of these group of companies is very, very large. That is one. Second, investors will start losing confidence in the market. That is not a good thing. Third, companies, or let's say the institutions such as LIC, SBI have invested a lot of money in purchasing the shares or have given a lot of loans to this company. And as a result of this, they will also suffer, which is not a very good thing for these institutions to show for. And as a result of this, there could be a domino effect, spillover effect, which might lead to certain crashes in the stock market. And please understand, it's not that only the domestic investors are associated with this share or stock of the group of companies. Even there are foreign institutions which are linked to these stocks. And they will also have to bear the brunt of crash in the share prices of these companies. So these are certain very important points regarding the short selling concept that has been discussed or that has been there in the newspaper for last couple of days. Now based on this, I've given a question here. Which of the following statement is correct regarding short selling? The investor is benefited by the rise in the price of the share. Wrong. The investor is benefited by drop in the price of the share. Of course, yes. Again, when I say investor is benefited here, I'm basically expecting after borrowing the shares, the prices to go down. That is the point I'm referring to here. Short selling comes under regulatory purview of RBI? No, it comes under SEBI, Securities Exchange Board of India. And whenever you talk about short selling, please understand short selling can be done in multiple ways. That is, I literally borrow the shares and do it today itself. That is the certain number of shares. Or I can do it even using the futures and options trading platform or the market as such. Right? So there are different ways through which you can conduct a short selling in the market. So right option for the question is option B. Now before I go to the next one, before I go to the next article, here is a very important point. Whenever you come across the articles related to Adani Group of companies, especially in the current affairs, in the recent times, focus on certain ratios which are mentioned in the newspapers. I hope you understand. Certain corporate ratios will be mentioned in the newspapers. Please focus on the ratios. Suddenly UPSC can pick up one of the ratios and ask you a question on it. Let me go to the next article. Again, very, very important. AT1 bonds or additional tier 1 bonds. This is not the first time that we are discussing the concept of additional tier 1 bonds in the session as such. Earlier videos also, multiple times we have been discussing additional tier 1 bond. But a very recent judgment of Bombay High Court has thrown a huge discussion, a huge amount of a discussion related to the additional tier 1 bonds as well as tier 2 bonds. What is the story here? Understand the story. Let's go step by step. In Indian market, specifically within the banking sector, RBI, Reserve Bank of India, has allowed the banks to issue multiple types of debt instruments, borrow capital, borrow money from the market so that they are able to meet the Basel guidelines. One such very important Basel guideline is Basel Guideline 3, under which the banks are supposed to meet certain limit of capital adequacy ratio. In order to meet the capital adequacy ratio, banks have been allowed to issue tier 1 bonds as well as tier 2 bonds. But within this concept of tier 1 and tier 2, the latest discussion has been happening regarding additional tier 1 bond. Now, what is this additional tier 1 bond? In a nutshell, these are nothing but the debt instruments which are issued and the capital is borrowed, money is borrowed, and whatever money is raised, collected by issuing these additional tier 1 bonds, that will be counted as a part of tier 1 capital under Basel 3. Have any banks in India issued the additional tier 1 bonds? Of course, yes. Multiple banks have issued. Now, let me focus on Yes Bank here. Yes Bank has issued the additional tier 1 bonds in 3 tranches, in 3 rounds in simple terms. One was issued in 2013, second round was issued in 2016, and the third round was issued in 2017. Now, that is step number 1, which means the bank has issued additional tier 1 bond, borrowed money, and the specific feature of additional tier 1 bond is additional tier 1 bond offer a higher coupon rate, higher interest rate, because the risk associated with the bonds is slightly higher. Meaning is very simple. Imagine I'm a bank, I'm issuing an additional tier 1 bond to you. You give the money to me, which means I've borrowed money from you. In certain situations, I'll collectively call them as point of non-viability, PONV, which means if I repay the amount, I do not have any way to continue the operation, I'll have to shut down. So whenever the bank reaches the point of non-viability, the bank is allowed to write off or convert these additional tier 1 bonds. And the Yes Bank in 2020 started a rise in the NPAs, and as a result of this, point number 2, RBI took over the management of the bank, and when I say took over the management, they appointed an administrator for the bank, and this administrator reconstituted the bank. Reconstituted simply means a plan was implemented. Reconstituted the bank, a plan to basically turn around the bank was implemented. And in the process of reconstituting the bank, and this is the most important point, in the March 2020, the bank was reconstituted, and in the process of that, after the plan was implemented, the administrator came out and stated that we will write off additional tier 1 bond. I hope you understand. The administrator announced that we are going to write off means simply cancel, write off additional tier 1 bond, which means what? Imagine you have purchased additional tier 1 bond from me. I'll have to repay the principal amount, let's say 100 rupees. Write off simply means I will not be repaying the 100 rupees to you. I do not have any obligation to pay now. That liability has been cancelled. This was announced by the administrator of Yes Bank. Now, some of the investors were unhappy. They approached the High Court. High Court looked at all of this issue and very recently has announced that the write-off that was announced by the Yes Bank, it has ruled that the write-off that was announced by the Yes Bank of additional tier 1 bonds worth 8,400 crore rupee is nullified. Nullified means not allowed, cancelled. Right? What is the meaning of it? It simply means the bank has to repay this amount of 8,400 crore rupees now. That is point number 1. Second, what were the reasons? Why did the Bombay High Court come to the conclusion of cancelling the decision of the administrator? These are some of the points. Point number 1. There was an allegation of the buyers or the investors in the additional tier 1 bond that when these AT1 bonds were sold to them, all the relevant information was not given to them. In simple terms, there was an allegation of mis-selling. What is the idea of mis-selling? I will sell a product to you without giving a complete information related to the product. For example, when you want to invest in the bond, I will tell you that you can keep your 100 rupees in the fixed deposit, you will get 5% rate of interest. You can invest in government bond, you will get 5.3%, let's say hypothetically. But you invest in these additional tier 1 bond, I will give you 6.5%. So obviously the investors in search of higher returns will be lured in, will be looking at this 6.5%, attracted by it, they will invest. But who will tell them about the risk related to the bond? Who will tell them if the bank incurs a loss, they have the provision where they can simply write off your investment in the bank. All of this information was not provided to the investor. There is an allegation of mis-selling. The Bombay High Court also stated that when the administrator brought in the reconstitution plan and implemented it, there was no provision in the reconstituted plan about writing off of AT1 bond. In simple terms, administrator has written off the AT1 bond liability, but that provision, that announcement was not part of the plan that was a reconstitution plan. That is the second reason. Third, the Bombay High Court also observed that the administrator has gone beyond the powers that was given to the administrator by the Reserve Bank of India. There is no mandate as such given by RBI to write off these additional tier 1 bond to the administrator. So administrator has simply breached the powers that was given to the person. So these are some of the reasons citing which Bombay High Court has cancelled the write-off of Yes Bank AT1 bonds. Now what is the implication of it? First one, Reserve Bank of India as well as Yes Bank of India can approach Supreme Court of India against the decision or the order of Bombay High Court, which they have already done. Second very important point, let's say hypothetically, even the Supreme Court of India will uphold the decision of the Bombay High Court. If that is done, it simply means now the Yes Bank will have a higher liability, and as per the latest statement given by the Yes Bank, even if that happens, the liability is just a small percentage. It will not dent a huge impact. It will not be denting the finances of the bank. But if you go beyond this, any other issues related to this, then there was one more bank, Lakshmi Vilas Bank, LVB. Lakshmi Vilas Bank had issued tier 2 bonds and had borrowed from the market, incurred losses, wrote off the valuation, or let's say the value of all the tier 2 bonds. If the Supreme Court of India upholds the decision of the Bombay High Court, then rest assured, even this decision of the LVB to write off tier 2 banks will be questioned. Already there are many cases or many high courts where this decision of the LVB has been questioned. So again, that will also come into prominence. So these are certain very important concepts or the aspects related to the Bombay High Court order related to additional tier 1 bonds. Next important article is related to Food Corporation of India introducing AI technology, artificial intelligence technology. Now before understanding, very small concept, but before understanding this, I want you to have a look at this question. The question simply says, Operation Connect, recently seen in news, is dash. Let me explain this, then you will understand why the article of FCI introducing AI is relevant for UPSC. Very recently, Central Bureau of Investigation launched Operation Connect. And what happened under Operation Connect? Simple. Central Bureau of Investigation conducted raids or searches at various government officials' places and have booked multiple of them, more than 50 of these officials, under various corruption activities. But why? What was the reason? Reason is very simple. The Food Corporation of India will procure food grains. Procure in the simple term, purchase a food grain from the farmers and use the food grains to distribute under various distribution programs of the state government as well as central government. Again, the distribution is done specifically by the state government. But please understand this. Whenever FCI will purchase these food grains, these are not the food grains which are directly distributed to the people. For example, paddy is purchased, dehusking is done, rice is actually distributed. Now there have been instances, again I'll go as per the charge sheet filed by the CBI or at least the allegations done by CBI. The CBI says that at various places in the process of procurement, there was a corruption. Corruption means various officials were involved where they accepted bribes and purposefully procured or purchased very, very low quality of food grains. And they've used these low or inferior quality of food grains for giving it for distribution purposes. And to basically find out how many are involved, who has to be charged, who has to be brought under this, etc., etc., CBI launched Operation Connect. Now have a look at this. Operation Connect, recently seen in the news, is associated with investigation launched by the CBI into FCI corruption. Right option is option C. Now many of you will be thinking, sir, what is this new thing that you're doing? First you're discussing question, then you're looking at the article. What is this new, basically a practice? You'll understand the reason now. Very recently, Food Corporation of India has announced that they are implementing or they will be installing 50 artificial intelligence based automatic grain analyzers at various depots. What is the reason? The reason is simple. Here is an FCI official, Food Corporation of India official. Let's say you are that official. I will bring the food grains to you and basically you will conduct a test on this. You will try to find out what is the quality of food grain. Now the Food Corporation of India official has the power to reject the food grains. They will have the power to accept or reject the food grains citing quality concerns. Now this can lead to corruption. This can lead to a dispute between the seller, that is the farmer, as well as the procurement officials. In order to address this issue, That is one, basically in order to reduce the human interface, in order to ensure there is no biased approach followed by the Food Corporation of India officials here. Now FCS says they'll be implementing automation systems, that is artificial intelligence based automation food grain analyzers, which means these systems or this technology automatically will be testing the quality, and based on the fixed parameters, either they will allow you to submit the food grains, or they will basically allow, or they will basically reject the food grain. That biased approach that could be followed by the FCA officials now will be addressed. That is one point which has been mentioned here. Now, what is the connection to current affairs? Don't you think if this kind of a technology is implemented by FCI, the human interface, that is the bias that the officer can have or may have, that will not be an issue now. The corruption that has happened as per CBI, that will not be an issue with the introduction of the technology. In addition to this, the article also says various squads have been set up, which consist of, or various teams have been set up, which consist of FCA officials who will go to the site of inspection, and if there is any dispute between the seller as well as the government official, they will try to look into it and resolve the dispute very quickly. So these are the 2 points which have been mentioned in the article. Apart from this, the data, the how much procurement has been done by the government, etc., not at all relevant for UPSC. Don't worry about it. Now let me go to the next article. Very recently, a report has been published by State Bank of India, and this report talks about the effectiveness of the scheme which has been launched by the government, ECLGS, Emergency Credit Line Guarantee Scheme. Now the idea of ECLGS is not a very new concept as such. That has been introduced for many years now, especially during the pandemic. The government, in order to address the credit related issues that were faced by the micro, small and medium enterprises, launched a scheme by the name of ECLGS. Now the article discusses the effectiveness of the scheme. It doesn't talk about the implementation, etc., the effectiveness of the scheme. And that is the point you need to focus on, and rest of this is just factual information. So what is the factual information? The article also discusses when the scheme was launched, right? And apart from this, what is the scheme all about? Basic idea, such as it was launched during the pandemic situation, COVID-19. And under ECLGS, the government wanted to ensure that the MSME enterprises, which have basically an outstanding loan of up to 50 crore rupees and right, basically a turnover, the revenue of right, 250 crore rupees, if they are finding it very difficult to get access to loans, now Government of India provided 100% guarantee to the loans, allowed the MSMEs to borrow from the market, borrow from the banking sector. What has been the benefit? Only one point of information here. What has been the benefit? The benefit has been that as per State Bank of India's Economic Research Department, ERD, they have published a report, and as per the report, they say that around 14.6 lakh MSMEs, remember the data, around 14.6 lakh MSMEs, if this facility was not provided by the government, would have become a non-performing asset. I can put it in another way also. The scheme has saved around 14.6 lakh MSME accounts from becoming an NPA, non-performing asset. Right? How? How is that possible? Simple. If an MSME is finding difficult to take a loan, produce the goods and sell in the market, basically it will not be able to generate revenues. And if it doesn't generate revenues, there is a very high likelihood that it will become right an NPA, because they don't have revenues in order to repay the loans that they have taken earlier from the banking sector. And with the introduction of ECLGS, because the government is providing guarantee for the loans, banks have given loans to the MSMEs, which have been able to take the loans, produce the goods, sell them, also repay the loan to the bank, which could not have been possible in the absence of ECLGS. So this is the information related to the success of ECLGS scheme. Keep it with you. If at all a question is asked by UPSC, for example, sir, where can I use all of this information? Imagine a question like, discuss the recent initiatives or reforms which are undertaken by the government to protect the MSME sectors in India. Here is a point for you. You can write this particular point very well, quote the research report also, you will get very good marks. Let me go to the next article. India has finally basically shifted to the T+1 settlement system. From Friday, India has fully shifted, that is the stock market has fully shifted to T+1 settlement system. Now before understanding this T+1 settlement system, here is a chronology. Before 2001, right, or up to 2001, we followed a weekly settlement. That is, after a week, a settlement of the transaction was done. I'll tell the concept of settlement also, give me a minute. Then in 2003, government said, let's not go for weekly settlement. Let's go for T+3. T+3. Later it was brought down to T+2. Now finally, from last year, we have shifted partially. Finally, last year, we shifted to partially the T+1 settlement. Now, India has become, right, another country in the world, specifically after China, to implement the concept of T+1. Again, in the context of China, all the transactions, not necessarily, right, but in India, all the transactions now will be, right, shifted to a T+1 settlement system. Right, they will use the term T+1, or they will also say same day settlement. Again, do not be confused by the term same day settlement here. Let me explain. Imagine you have a share. I will purchase the share today. Does it mean that immediately you will transfer the share to me and I will transfer the money to you? Do you think that is how the stock market will work? If yes, then you are wrong. It is not how the stock market works. The transaction is done. That is, we have agreed that I will take a share from you and I'll give the money to you. But the settlement now, settlement means actual transfer of money to your account and actual transfer of share into my demat account, until now used to happen in next 2 days. Meaning what? Let's say today is Monday. Today you have sold the share to me. I will transfer the money to you. But the settlement of the transaction, clearing of the transaction used to happen in the next 2 days. Today will be referred to as a T and +2 next 48 hours. That is, by Wednesday, this transaction would be settled. This has been reduced to T+1 now. In simple terms, if same transaction is done now, in the next 24 hours, the settlement of the transaction will take place. That is basically the concept of T+1 settlement system. Now, why we have shifted to T+1? Very simple. With shifting to T+1, the settlement of the transaction will happen very soon, much sooner now. There will be multiple trades that can be conducted in the market, because now you will get the money much sooner. I will get the shares much sooner compared to earlier system. So the number of transactions or the trades in the market are expected to increase. This is expected to increase the efficiency of the stock market. But in addition to this, there has been a growing demand, especially from certain investors, not to implement it. Certain investors are concerned that, one, if you shift from T+2 to T+1, they will have to implement certain systems now, which means again additional expenditure. But apart from this, certain foreign investors were opposed to this for a very simple reason. The time zones are different for both of us. That is, Indian investors have a different time zone compared to an investor from Europe or USA. And that could lead to certain operational difficulties for the foreign investors. So these are certain very important points regarding the T+1 settlement system that has been implemented now. Next article is related to loosening, right, EPCG norms or easing EPCG norms. First and foremost, what is this EPCG? EPCG is a name of a scheme, Export Promotion of Capital Goods Scheme, EPCG. Now, the concept of EPCG has been introduced for more than 2 decades in India. During 1990s, the idea of a EPCG was implemented. Under EPCG, what will happen? Let me explain. Imagine you are importing a machinery into India, right? A capital good. Now, when you are importing a machinery into India, you will have to pay customs to the government, that is taxes to government. Government of India said, in order to promote production in India, let me exempt the customs duties. Hypothetically, imagine you are supposed to pay $10 in the form of customs duties. Again, dollar or rupees, don't worry about it. Focus on the concept here. Government said you don't have to pay this customs. You import the machinery, right? That is capital goods. Even if it is a new good or a reselling, doesn't matter. You import it. You don't have to pay customs to me. But there is one obligation that you are supposed to follow. What is the obligation here? If I give you a complete exemption of customs duties, you will have to promise me that in the next certain set of years, certain number of years, you will be exporting 6 times the exempted customs. 6 times the amount of exempted customs. That is, if I want to put it in the numbers here, if the customs duty exempted is $10, then in the next set of years, certain number of years, you will have to ensure that you will export 6 times this $10, that is $60 worth of goods from India. That is basically how the Export Promotion of Capital Goods or EPCG scheme was implemented by the government. Now, many of you will basically ask me, sir, if I'm not able to export, let's say $60 worth of the goods from India, then what? And then what will happen? In case of the defaults like this, Government of India had a fees called as composition fees. Composition fees. Don't be confused between composition scheme under GST and composition fees under these kind of export related schemes. Composition fees would be implemented if you are unable to meet the export obligations. Simple. You will have to bear this particular fees or pay the fees if you are unable to meet the targets that have been given to you in the context of exports. Government of India now says, we will ease these norms. Now, why these norms have been eased? Reason is very simple. In recent times, there is a concern over declining exports from India. Again, please understand my statement here. Compared to previous years, definitely yes, no doubt, exports have increased. But the concern is that in the month of December, the exports have actually declined. And in the coming months, there could be a recession in some of the developed economies such as USA, European market, etc. In order to address the declining exports now, Government of India says these kind of norms that we have, we will ease them so that you will be able to export more and more, and even in case of default, you don't have to be worried about paying of the fees. So these are some of the points related to EPCG scheme or easing of EPCG norms. Next article, land monetization. Now what is the idea for monetization? Simple. On one side we have selling of the asset, which generally the government does under the policy of disinvestment. Done? Under disinvestment, government sells ownership of the companies. Small percentage or 100%, doesn't matter. Disinvestment is associated with selling of the assets. On the other hand, we also have a process called as monetization. Under monetization, government doesn't sell the asset, government merely leases out the asset. If I have to put it in a very simple terminology or simple way, the right to impose and collect the revenue or related to the asset will be given to somebody else, a private sector company. So what do you mean by that? Imagine there is a national highway. Government can impose and collect the revenue directly in the form of a toll, Rather than government doing it, they will lease out the national highway to a private sector company for let's say 30 years. Now the right to collect the tolls from the vehicles which are moving on these roads or which are using the road will be given to private sector. Right? That concept is called as monetization. Merely the asset is leased out, not sold as it is done in the disinvestment. Now many of you will be asking me, sir, if it is monetized, what is the advantage for government? Don't you think government is losing the right to impose and collect revenues here? Yes, the government will not be imposing the revenues and directly collecting. Now, government will basically be asking for revenues from the private sector company to which the land or let's say the company has been or let's say even the road has been monetized to. Now, in order to monetize the land related to let's say certain public sector companies which are about to be closed down, etc., government in the last year's budget announced an authority by the name of National Land Monetisation Corporation, NLMC, National Land Monetisation Corporation. This authority has been approved by the cabinet. We also have launched the authority, but the concern that has been raised in the article is that the authority doesn't have a full-time CEO as of now. Right? There is a secretary who is taking care or who is basically acting as a CEO of this NLMC, that is National Land Monetisation Corporation, but there is no full-time CEO, right, appointed in the NLMC. And as a result of this, land monetization of various public sector enterprises might be slowed down, and that would affect the amount of revenues that the government is able to generate by monetizing these assets. And please understand, whenever government wants to sell away the assets of the company, you'll have to ensure, or government wants to sell off a company itself, public sector enterprises, you'll have to monetize the assets of the company first. For example, a company, public sector enterprise, owns a lot of land. You would want to monetize the land, sell away only, let's say, the manufacturing company to a buyer in the market. But if this authority does not function efficiently, is not having full-time members like this, the whole process might get delayed. And as per the information that has been provided in the article, it simply says until unless the next Lok Sabha elections are over in financial year 24, this might not become a priority for the government. So these are some of the important points regarding the National Land Monetisation Corporation. And the last article for the day, a simple factual information, government might simply cover green hydrogen under RoDTEP and promote the exports of the green hydrogen. In the last couple of weeks, there has been a lot of discussion related to the initiative of the government of India to promote the production of green hydrogen in India. And the article says that government so far has announced incentives worth more than $2.1 billion to promote the production of green hydrogen in the domestic market itself. In addition to this, in the coming days, Government of India, in order to promote production as well as export of this into the international market, because under the National Green Hydrogen Mission, one of the objectives is to not just promote the production, but it is also to promote exports of green hydrogen from India. Now, the article says that in order to do that, government might simply bring in the green hydrogen export under RoDTEP, remission of duties and exports on products, export products, in order to promote the export of this. And under RoDTEP, which we have discussed a couple of times, or let's say many of the times in the earlier videos as well, objective is to promote an export of this by ensuring that, right, by ensuring that whatever embedded taxes are there in the system, which the exporter has already paid, will be refunded, remitted back to the exporter. So that is one more important point related to the green hydrogen mission of Government of India. So these are the various articles as well as the questions related to articles which have appeared from 21st January to 27th January 2023. If you like the initiative, hit the like button and provide your valuable comments in the section below. And if you're yet to subscribe to BYJU'S Exam Prep IAS YouTube channel, kindly do it now. Thank you. Have a great day.